Welcome to this edition of Julius Baer's Moving Markets, The View Beyond, a series of podcasts in which we delve a little deeper into the topics on investors' minds. After a phenomenal performance in 2025, gold and silver have continued to rise at the start of this year, primarily driven by geopolitical factors. Until President Trump arrived in Davos on the 21st of January, gold was up 11.5% in 2026 and silver was up 32%. Following on from his comments in Davos last week that some kind of a framework can be agreed regarding US presence in Greenland, there may well have been a blip, but the new week has brought another big rally, with silver surging to 110 and gold coursing through $5,100 per ounce at the start of this week. What's been behind this inexorable rally in precious metals? Can it continue? And how should investors be approaching this? By taking profits or getting on board the metals train? Well, my name is Bernadette Anderko, and joining me to answer the questions today are Carsten Menke, Julius Baer's Head of Next Generation Research, who's sitting with me in the studio, and Chris Irwin, Julius Baer's Head of FX and Precious Metals Trading, who's joining us live from Singapore. Before we start, I would like to ask our listeners to listen right through until the end of the podcast to make sure you hear the important legal information. So, hello to both of you.
Hello, Bernadette.
Hi, Bernadette.
Now, I already mentioned it, gold and silver started 2026 strongly on heightened geopolitical risk. From your perspective, what were the most important catalysts behind that initial rally?
Well, I think to start with, it is important to remember that the precious metals typically do not provide a good hedge against geopolitical risks, unless the events have a significant impact on the economy and or financial markets. So from that perspective, what we are currently observing, I would say, is very different, as geopolitics seem to be in the driving seat of the markets, as you said in the introduction. Why is that? Because the US is at the center of geopolitical risks, potentially impacting the outlook for the US dollar and also US interest rates, and obviously precious metals react very sensitively to that. That said, it's not about Trump. By the way, we always talk about Trump, but I think this already started with the Biden administration's weaponization of the US dollar a few years ago, which fueled massive gold buying from emerging market central banks, most notably, of course, China. Trump is, only adding to this, also luring private investors into the markets, some being safe haven seekers, but others being speculators. And for me, the wave of speculative flows we've seen in the silver market, in particular in China, are unprecedented. Long story short, the fundamental backdrop for gold and silver was very favorable in 2025 and is still very favorable at the start of 2026. Whether this justifies gold at more than $5,000 per ounce and silver at more than $100 per ounce, I think is up for discussion.
Okay, then from a trader's standpoint, what have you noticed in terms of flows and speculative positioning or even physical demand during this recent rally in prices, Chris?
Well, Bernadette, I think I'll start things with gold, because for me, it's still the core narrative behind this incredible rally across precious metals. So what's interesting there is specs came into this move pretty underpositioned. So even now, the non-commercial length on the CME isn't particularly stretched. It is elevated versus Q4 last year, but it's nowhere near frothy. And then if you talk about ETFs, Western vehicles have been buying at a steady, healthy pace. So total holdings there are just above 100 million ounces. And that's about a 20 million ounce increase from about this time last year. And then if you look at Chinese onshore ETFs, there's a bit of a stop-start during last year's rally, but they've switched gears again and are now seem to be chasing the market higher. So around 700,000 ounces of buying there in the last month. And about 2/3 of that has occurred in the last week. Also, we're seeing the Shanghai physical premium swing back into positive territory after an extended period of trading very negative. That being said, though, I do feel that higher prices, we're going to start to see some pressure on physical and jewelry demand, a bit of demand destruction at this level.
In my view, the Shanghai Futures Exchange has been instrumental in driving this rally since the end of last year in particular. So speculative positioning of the largest futures firms is at a record high on an absolute level, as well as relative to the outstanding contracts. Meanwhile, for silver, we've seen futures trading volumes multiply around the turn of the year, with contracts changing hands multiple times a day. I'd say this is as far from safe haven seeking as it gets. That's pure speculation. Chris, I'd like to get your thoughts on an idea that I've been pondering as of late. We often hear that the silver market is very tight. So spot trades higher than futures, leads rates are skyrocketing, and the exchange for physical is very expensive. I wonder if much of this is because from a trader's perspective, silver is seen as a currency. If it was seen as a commodity and traded as one, would the impression be the same? If you take the base metal markets or the energy markets, it is the norm, not the exception, that the markets are imperfect, that supply is in the wrong location, and that regional spreads diverge quite significantly.
Yeah, I think that's a fascinating point, and I do feel you've hit the nail on the head there. The silver market does feel tight largely because so many investors aren't looking at it purely from an industrial standpoint. It's almost like a gold light. And once you frame silver like a currency, every little basis move does suddenly feel like a macro signal. So if spot trades over futures, it must be scarcity. If lease rates begin to jump, that must mean a liquidity squeeze. But that's really through a gold market lens and being projected straight onto silver. What's interesting is these dislocations we've seen over the last 18 months or so aren't actually the norm for precious metals. In base metals, this is just business as usual, you know. If you have metal sitting in the wrong place, that's just a Tuesday for them. And regional spikes, premium spikes happening, that happens every single year. No one really calls it a crisis. They just call it basis risk. Silver, though, does get painted as this monetary asset, even though the bulk of today's demand is industrial. And honestly, that's partly a situation of our own making. We've built this market structure where a significant amount of the metal sits in vaults across various trading centers. ETFs act as this macro vehicle, and then there's this ingrained view historically of silver as money. So the whole system is primed to interpret what are essentially logistical frictions as this sign of monetary stress.
All right, then why don't we talk a little bit more about geopolitics? President Trump's post-Davos comments around a framework for the US involvement in Greenland seem to have now eased some of the political tension. That's at least what financial markets are signalling more broadly. So how is it then that gold and silver have continued to rally?
Yeah, interesting. Historically, gold has always shown that classic knee-jerk reaction to geopolitical flare-ups. We've seen it repeatedly with Middle Eastern headlines and very clearly in early 2022 surrounding Ukraine. Typically, if a conflict stays relatively contained, that geopolitical premium fades out fairly quickly. Now, let me start by saying the situation right now is extremely fluid, so I do want the flexibility to adapt as developments unfold. As we've seen in the last week, it's a lot of changes happening. But I don't think what we're seeing around Greenland fits this classical geopolitical premium template to me. This looks much more like a deeper erosion of confidence in the US and more broadly a shift in the appetite to hold US assets going forward. So I feel central banks have been leaving breadcrumbs in this direction for several years, diversifying reserves, adding to gold. This is no longer a fringe narrative. So large institutions are now seriously asking the question, what is a hard neutral asset we can hold in a world where old assumptions may no longer apply? So even if some investors believe we can ride out the next 3 years, this episode has really highlighted a real inconsistency in investing in a country like the US. US Treasuries were preaching gospel in economic textbooks as the ultimate safe haven. Is that the case going forward? I'm not sure. On top of that, both China and the US have, within the last 6 months, explicitly flagged silver as a critical material. So markets are really paying attention to this as well.
Absolutely agree, Chris. As I said in the beginning, for the first time ever, the world is starting to doubt whether the US will remain the reliable international partner it used to be, both politically and also economically. Related to that, I think the doubts about the status of the US dollar are growing as well. While we don't see these doubts in the US dollar market yet, they clearly show up in the much smaller gold and silver markets.
All right, then since late November, we saw an acceleration in silver's rally compared with gold, and silver's often seen as gold's little sibling, tending to follow but move more impulsively. Have you noticed anything specific trading-wise during this time?
Yeah, I'm glad we're touching onto this point because I've said this before on several podcasts. I do look at the gold-silver ratio as a barometer for an overall momentum across the precious metals complex. And for some time last year, it was incredibly stubborn. It sat above 80, even with all the attention to the space. So to me at the time, silver looked deeply undervalued relative to the move we'd seen in gold over the last couple of years. So this breakout really felt like an overdue catch-up. That said, the pace of this move over the last month has been, well, a lot. So I do feel it has gone too far too fast. But on the other hand, I do feel that silver is trying to find an equilibrium right now. The ratio has completely overshot. We're now trading below 50, but whether the price of silver ultimately sits at $70, $100, or $150, I think is too early to call. What's undeniable is this kind of explosive price action pulls in a wave of speculative interest, and right now the market is absolutely packed with speculative length. So I've seen silver bubbles before in my career, and I've watched the metal drop 30 to 40% in a few days when the air eventually comes out. This week alone, we've seen the metal pull back 14% from the highs in one day. So yes, silver needed to catch up, but the velocity is starting to feel a touch disorderly. So I think you need to be cautious now.
When it comes to the fundamental difference between gold and silver, I think we need to talk about that as well. There are two which I think we should mention here. So firstly, the gold market is much bigger than the silver market by a factor of 8. Thus, it needs much less money to move the silver market than it needs to move the gold market. And this also explains why silver's volatility is much higher and why it is so susceptible to swift and sharp price swings. Second, more than half of silver demand is coming from industrial application. That is mostly electronics, where it's used as a conductor, e.g. in solar modules. These are real factories that purchase silver as a raw material, and at today's price, they struggle. They struggle big time. So there is no doubt that these prices will cause demand destruction. We've heard it already from some Chinese solar module makers. They will shift away from silver for cost reasons, using industrial metals instead. And we actually think that silver solar demand might have peaked already, despite the fact that we're strong believers in the energy transition. But already today, the world produces enough solar cells to be able to enable the energy transition, while grids often cannot cope with larger installations.
All right, then. So putting geopolitics aside for a moment, what macro factors should gold or silver investors be paying the most attention to right now? Should it be interest rates, inflation expectations, or the US dollar?
Everything at the same time. No, I have the impression it is all about the outlook for US interest rates and the US dollar at the moment. This is what's luring most of the safe haven seekers into the market, plus concerns about the US Federal Reserve's independence due to the persistent pressure applied by President Trump. But this is only the fundamental case for silver, which in my view is not what's been pushing prices to $100 per ounce and beyond. Flows dominate fundamentals at the moment. Just look at the volumes of the silver contracts on the Shanghai Futures Exchange. And this is not about physical silver, it's not about a safe haven, it's purely about price performance.
I do agree with what Carsten said. I also feel that the constant pressure we're seeing on the Fed and this threat to independence is also something that warrants a lot of attention right now.
All right, then. So finishing with you, Carsten, given the backdrop we've discussed, what should investors focus on now when it comes to precious metals?
Let's start with gold, because it's easier, relatively speaking. For gold, we see a bull market that is based on two pillars. The first one is buying from central banks, which want to be less dependent on the US dollar. This could very well continue for another 3 to 5 years. It's a structural factor. The second one is buying from safe haven seekers, which for us, for now, is a cyclical factor. It's driven by slowing US growth, lower US interest rates, and a weaker US dollar. Should there be more interference with the US Federal Reserve, and should the world doubt the status of the US dollar, this could become a structural driver as well. Then, topping everything, we also have speculation in the gold market. That said, it's not as excessive as for silver, and the likelihood of a reversal seems rather low in our view.
And silver then?
Well, silver is much trickier. As I said, flows dominate fundamentals, and I cannot give you a convincing reason why these flows should not take prices to 120 or 150. This is entirely possible. Would it be justified by fundamentals? Certainly not. Will it harm fundamentals in the medium to longer term? Certainly yes. So what's the bottom line? If you hold gold and silver, you should consider some hedges to protect the performance you've generated during the past few months. And if you don't, you need to be aware that both are not cheap anymore, which might be stating the obvious, but you need to be aware that their risk profile is very different at the moment. Gold is still the more conservative option, while for silver, anyone buying now at these levels needs to have a very high willingness to take risks.
Okay, and is there anything you'd like to add on the trading side, Chris?
Well, potentially, I would like to leave listeners with two things. Firstly, I feel there's also a lot of misinformation in the precious metals market right now, especially on social media. So please always check the source of every article or video you come across. With AI, I feel it's exceptionally easy to make something sound very plausible. So I would definitely reach out to a specialist if you want clarity on a certain topic. And then secondly, this is going to be an extremely long period of heightened volatility in precious metals. We're seeing implied and realized vols touching levels we have not seen since 2020. So this is not going to be a straight path. The fundamentals surrounding precious metals do remain solid, but the pullbacks can also be very violent.
Thanks, Chris, for this very important point. Thanks very much for raising it. I think people need to be very wary about the bits and pieces of news and noise they are bombarded with.
Well, we'll certainly try to keep the noise cancelled for you on Moving Markets. That brings the podcast to a close for today. Thank you so much for making the time to join me, Carsten and Chris, and I'll look forward to no doubt revisiting the topic with you at a later date.
Thanks for having us.
Thanks, Bernadette.
And that concludes this week's View Beyond podcast. I hope you enjoyed the conversation today, and do please join us again next week for our next dive into what's on investors' minds. Meanwhile, goodbye for now.
The information and opinions expressed in this podcast constitute marketing material and are not the result of independent financial or investment research. Please refer to www.juliusbaer.com/legal/podcasts for further other important legal information.